It's rigged. The free market is dead. US Gov quietly forces. Prices up. For decades, investors were taught a simple rule. Prices move because of supply and demand. That belief shaped portfolios, careers, and entire business models. But what if that rule no longer applies, and hasn't for some time? What if prices today are not signals, but decisions? Behind the screens, behind the headlines, a quieter system is taking control. Not through chaos, not through collapse, but through policy, liquidity, and silent intervention. Markets still move, charts still update, but the mechanism underneath has changed. And in recent months, something critical happened. Something that forced governments to choose between ideology and survival. Most people missed it. Some noticed too late. Because when a state decides prices cannot fall, the free market doesn't crash. It disappears. What replaced it? Changes everything. For most of his career, the investor believed in a simple idea. Prices moved because buyers and sellers met in the open. When supply was scarce, prices rose. When supply was plenty, prices fell. This belief was not foolish. It was taught in schools, written in textbooks, and repeated by professionals across finance and business. It was the foundation of how risk was measured and how opportunity was judged. But over time, cracks began to appear. He noticed that prices often moved without clear reason. Sometimes markets fell, even when demand was strong. Other times, prices stayed low, even as inventories tightened. At first, these moments were explained away. Analysts blamed sentiment, speculation, or short-term noise. The system, they said, still worked in the long run. Yet the pattern did not correct itself. It deepened. The modern market no longer resembled a town square where goods were exchanged. It looked more like a control room, filled with screens, models, and rules that most participants never saw. Real buyers and sellers were still present, but they were no longer the main force setting prices. That role had shifted to intermediaries, liquidity providers, and policy-driven institutions. This change did not happen overnight. It happened slowly, through layers of complexity. Financial markets grew larger than the physical economy they were meant to represent. Paper claims multiplied faster than real assets. Contracts, options, and derivatives expanded far beyond the underlying supply. A single unit of metal, energy, or currency could support many promises at the same time. On paper, abundance looked endless. In reality, nothing had changed. This separation mattered. Prices began to reflect financial conditions, rather than physical ones. Liquidity became more important than availability. Stability became more important than accuracy. When volatility threatened the system, intervention followed, not always in public. Often, through quiet adjustments that kept markets moving without addressing the root cause. The investor started asking a different question. Not what is the price, but why is this price allowed to exist? In a true free market, price is a signal. It tells producers whether to invest and consumers whether to conserve. When that signal is distorted, capital flows to the wrong places. Shortages grow where surpluses appear on screens. Long-term planning becomes impossible. This is where the idea of the free market began to fail. Governments and central institutions were no longer neutral observers. They had become guardians of stability. Their goal was not perfect pricing, but continuous function. Markets had to open each day. Credit had to flow. Confidence had to remain intact. If prices fell too far or rose too fast, the system itself was at risk. So boundaries were created. Some prices were encouraged, others were restrained. The language used was technical, but the result was simple. Markets were guided, not left alone. This was not done out of malice, it was done out of necessity, at least from the perspective of those managing the system. But necessity has consequences. When prices are managed, they stop telling the truth. They stop reflecting scarcity, cost, and effort. Instead, they reflect tolerance. How much movement can the system accept without stress? How much loss can be absorbed without panic? The investor realized that this shift changed everything. Business decisions based on market signals became less reliable. Long-term investments faced hidden risks. Assets that looked cheap might be suppressed. Assets that looked stable might be protected. The rules were no longer the same for everyone, and they were no longer written in plain sight. This was especially clear in markets tied to national infrastructure. Energy, metals, and credit were no longer treated as neutral goods. They were treated as strategic tools. Their prices affected jobs, security, and political stability. And allowing them to move freely became a risk in itself. At that point, ideology gave way to control. The free market, as once understood, did not collapse. It was set aside. In its place stood a managed system designed to reduce shocks and extend time. Prices still moved, but within invisible walls. When they approached those walls, forces appeared to slow them down or push them back. Most participants never noticed. Charts still updated, trades still cleared. News still spoke of markets as if nothing had changed. But for those who looked closely, the message was clear. The market was no longer discovering prices. It was maintaining order. This realization did not demand panic. It demanded clarity. Understanding the system as it is, not as it was described, became essential. Because when prices are guided, opportunity and risk shift in ways that simple models cannot explain. And this raised the central question that could no longer be ignored. If markets are no longer free to fall, what happens when reality pushes upward? That question leads directly to the forces now shaping prices from behind the scenes. By the time the investor accepted that markets were no longer free in the old sense, a deeper question followed. If prices were not set purely by buyers and sellers, then who or what was guiding them? The answer was not a single actor. It was a system built over decades, shaped by risk management, leverage, and policy priorities. To understand this system, one had to stop thinking about markets as places and start thinking about them as mechanisms. In the past, price discovery depended on physical exchange. Goods changed hands, money followed. Today, most trading happens far from the underlying asset. Futures, options, and swaps dominate volume. These instruments were created to manage risk, but over time they became the market itself. The tail began to wag the dog. This change created leverage. A small amount of capital could now control a large exposure. One contract could represent many units of an asset that did not yet exist in hand. When repeated at scale, this allowed markets to grow far beyond physical supply. On screens, liquidity looked deep and endless. In reality, it depended on confidence and rolling promises. Confidence became the real currency. As long as participants believed contracts would settle smoothly, the system held together. But this also meant that sudden price moves were dangerous. Sharp drops could trigger margin calls. Sharp rises could expose shortages. Either direction threatened stability, so controls emerged. These controls were not always direct orders. They appeared as margin changes, liquidity injections, trading halts, and settlement rules. Each action seemed technical, even boring. But together, they shaped how far and how fast prices could move. The investor noticed a pattern. When markets became volatile, responses followed quickly. Liquidity was added. Rules were adjusted. Time was bought. This was not about profit. It was about preventing disorder. Banks played a central role in this process. They were not just traders. They were market makers and risk absorbers. They stood between buyers and sellers, providing liquidity when others pulled back. In return, they received protection. When losses threatened to spread, support arrived. This relationship blurred the line between private finance and public policy. Over time, regulators learned that letting prices move freely was not always desirable. A sudden collapse could damage pensions, credit markets, and employment. A sudden spike could strain supply chains and fuel inflation. Stability became the priority, even if it meant distorting signals. This is how price management became normalized. Prices were allowed to move, but only within acceptable ranges. When they approached danger zones, interventions softened the impact. These actions were rarely announced as control. They were framed as maintaining orderly markets or ensuring liquidity, but the effect was the same. The investor realized that in such a system, price no longer reflected truth. It reflected policy tolerance. What mattered was not scarcity or abundance, but whether a move threatened the broader structure. This was especially clear in markets tied to debt. Modern economies rely on borrowing. Governments, corporations, and households all depend on stable interest rates and predictable costs. Large price swings in key assets could ripple through balance sheets and cause systemic stress. Preventing that stress became a central objective. As a result, markets were quietly shaped to serve debt sustainability. Low volatility supported borrowing. Managed prices supported planning. From the perspective of policymakers, this was rational. From the perspective of price discovery, it was distortion. The investor also noticed that penalties for misconduct rarely changed behavior. Fines were absorbed as expenses. Settlements closed cases without altering structure. This reinforced the idea that the system itself was not meant to change. It was meant to continue. This continuity required trust. Participants needed to believe markets were fair enough to function, even if they were not truly free. Transparency was selective. Complexity acted as a shield. Most people did not see the full picture, and those who did often lacked the power to challenge it. Yet every system has limits. When prices are held below natural levels for too long, supply suffers. Investment slows, capacity shrinks. The effects are not immediate, but they accumulate. Eventually, reality pushes back. The investor understood that this was the risk of control. Managing prices could delay problems, but it could not remove them. When physical constraints met financial promises, the system would be tested. This was not a theory, it was a process already underway. The question was no longer whether prices were managed. That was clear. The real question was why this management was intensifying now. The answer did not lie in markets alone. It lay in geopolitics, resources, and national priorities. To understand where this leads, one must look beyond finance and toward the assets that modern economies cannot function without. By this stage, the investor understood that price control was not accidental. It was not the result of a few bad actors or temporary policies. It was structural. But one question still mattered more than the rest. Why were some markets controlled more tightly than others? The answer was not financial, it was strategic. Certain assets had crossed a threshold. They were no longer treated as ordinary commodities. They had become essential inputs for national systems. Energy, metals, and key materials were no longer judged only by profitability. They were judged by availability, reliability, and control. Silver was one of those materials. In textbooks, silver was often described as a precious metal or an investment hedge. In reality, it had become an industrial backbone. It was used in power grids, electronics, medical equipment, and advanced manufacturing. Modern technology depended on it in ways that were difficult to replace. The investor noticed a contradiction. Publicly, prices suggested abundance. Privately, supply chains told a different story. New projects were slow to develop, costs were rising, environmental rules, labor shortages, and long permitting timelines made expansion difficult. Yet prices did not reflect these pressures. This gap was not random. When prices stay low for extended periods, investment dries up. Companies delay exploration. Capital moves elsewhere. Over time, production capacity weakens. This is not speculation. It is basic economics. But in strategic markets, the usual correction mechanisms were muted. Governments were aware of this risk. They saw that underinvestment today created vulnerability tomorrow. If supply chains failed, the consequences would not be limited to balance sheets. They would affect energy security, defense readiness, and technological competitiveness. In that context, allowing prices to fall freely became dangerous. The investor realized that price suppression had become a liability. Low prices benefited consumers in the short term, but they discouraged producers in the long term. They also shifted advantage to countries willing to stockpile quietly. When materials were cheap, strategic buyers accumulated. When shortages appeared, control shifted. This dynamic changed how states thought about markets. The goal was no longer efficiency alone. It was resilience. Resilience required stable supply, predictable production, and domestic capacity. These goals could not always be achieved through free pricing. Intervention became a tool, not an exception. The language around this shift was careful. Officials spoke of critical materials, supply chain security, and national interest. These terms signaled a change in priorities. Markets tied to these categories were no longer neutral arenas. They were instruments of policy. The investor also saw how this affected global trade. Countries that controlled production gained leverage. Countries that relied on imports faced risk. In response, alliances formed. Agreements were made to secure access and coordinate strategy. Prices became part of diplomacy. In this environment, volatility was unacceptable. Sharp price swings could disrupt planning and investment. A sudden collapse could shut down mines. A sudden spike could trigger political backlash. Stability became the objective, even if it meant abandoning pure market principles. This is where the free market quietly ended. Not with an announcement, not with a crisis, but with a decision that some assets were too important to be left to chance. Once that decision was made, everything else followed. The investor understood that this did not mean prices would stop moving. It meant they would move within boundaries shaped by policy. Floors would matter more than peaks. Downside risk would be managed, not discovered. This realization reframed the entire discussion. Debates about manipulation missed the point. The system was not trying to cheat. It was trying to survive. In doing so, it accepted distortion as a cost. But distortion has consequences. When prices are guided, signals weaken. Producers respond slowly. Consumers receive mixed messages. The longer this continues, the larger the adjustment required when reality asserts itself. The investor saw that this adjustment was approaching. Demand for strategic materials was rising. Infrastructure plans expanded. Technology required more inputs, not fewer. At the same time, supply remained constrained by years of underinvestment. Something had to give. Either prices would rise sharply or policy would step in to manage the transition. From the evidence available, the second path was already chosen. Governments were preparing to absorb the shock rather than allow markets to deliver it. This did not mean a return to central planning. It meant selective control. Key materials would be protected. Their pricing would reflect strategic value, not just market sentiment. For businesses and investors, this changed the rules. Traditional models assumed that prices corrected naturally. In a strategic market, correction is guided. The question becomes not what is the fair price, but what price level supports supply without causing instability. This shift marked the end of an era. The free market, as an organizing principle, had reached its limits in critical sectors. In its place stood a managed framework shaped by security concerns and long-term planning. The investor understood that ignoring this reality carried risk, because once a market becomes strategic, it no longer answers to traders alone. And the next step in this transition would make that unmistakably clear. By the time policymakers acknowledged that certain markets had become strategic, the old framework was already failing. Prices were no longer guiding production decisions. They were delaying consequences. And delay, while useful in crises, is not a solution. It is a bridge to something else. That something else began to take shape quietly. The investor noticed that governments no longer spoke about letting markets find their level. Instead, they spoke about ensuring continuity. Words like stability, resilience, and security appeared more often than efficiency or competition. This shift in language reflected a deeper change in intent. When an asset becomes critical, allowing its price to fall below the cost of sustainable production is no longer acceptable. The risk is not just business failure, it is system failure. Mines close, supply chains weaken, dependency grows. At that point, price becomes a policy problem. The response to this problem was not dramatic. It did not arrive as a single law or announcement. It arrived as a set of practices that, together, changed how markets functioned. One of those practices was the creation of implicit price floors. A price floor does not mean a fixed price. It means a level below which authorities are unwilling to let the market go. When prices approach that level, support appears. This support can take many forms: strategic purchasing, favorable financing, regulatory adjustments, long-term contracts. None of these need to be explained as intervention. They are framed as planning. The effect, however, is clear. Downside risk is reduced. Producers gain confidence to invest. Supply becomes more predictable. Volatility narrows. The market continues to trade, but the extremes are softened. Over time, participants learn where the boundaries are. The investor realized that this learning process was already underway. Markets were testing limits. Each time stress appeared, responses followed faster than before. What once required emergency meetings now happened almost automatically. The system had adapted. This adaptation marked the end of the free pricing era. In a free market, price discovery is the goal. In a managed market, price stability is the goal. These are not the same thing. Stability prioritizes continuity over correction. It accepts distortion to avoid disruption. From a government's perspective, this trade-off makes sense. Strategic industries cannot be rebuilt quickly. Skilled labor cannot be replaced overnight. Infrastructure projects require decades, not quarters. Allowing prices to collapse for the sake of purity risks permanent damage. So purity was abandoned. The investor also noted how this changed the role of the state. Governments became buyers of last resort. When private demand weakened, public demand filled the gap. When prices threatened to fall too far, official programs absorbed supply. This was not announced as control, it was presented as support. But support and control are closely related. Once a buyer with unlimited funding enters a market, price dynamics change. The downside becomes asymmetric. Losses are limited while gains remain possible. This is not speculation, it is structure. The investor understood that this structure favored long-term planning over short-term trading. Businesses that relied on stable input costs benefited. Speculators who thrived on volatility faced a different environment. The market rewarded patience, not speed. This shift also reshaped capital allocation. Investors began to favor assets protected by policy, not because they were risk-free, but because their risks were understood. The uncertainty moved from price collapse to political decision-making. That was a different kind of risk, but one that large institutions knew how to manage. The free market had not vanished entirely. It still existed at the margins. Prices still moved, trades still cleared, but the core was different. The center of gravity had shifted from discovery to direction. This direction was not ideological, it was practical. As debt levels rose and infrastructure aged, governments needed predictability. Sudden price shocks could ripple through budgets and balance sheets. Managing those shocks became a priority equal to growth itself. The investor saw that this created a new reality for decision makers. Old models assumed that prices would eventually correct excesses. New models assumed that excesses would be managed. This changed how risk was priced, how projects were approved, and how capital was deployed. It also changed expectations. Once markets internalize the presence of support, behavior adjusts. Producers invest with more confidence. Consumers plan with more certainty. The market becomes less reactive and more guided. This guidance does not eliminate cycles, it reshapes them. Corrections still happen, but they are controlled. Expansions still occur, but they are monitored. The system aims to smooth outcomes, even if it sacrifices transparency. The investor understood that this was not temporary. When states step in to protect strategic assets, they rarely step back. The reasons for intervention do not disappear. If anything, they grow stronger as systems become more complex and interdependent. Because in a market shaped by policy, the most important signal is no longer price alone, it is intent.